Good afternoon, and thank you for joining the Future of Finance webinar on Complacency about prime brokerage risk could kill hedge funds. I shall now pass you over to Dominic Hobson.
I'm Dominic Hobson. I'm co-founder of Future of Finance. It's my privilege to moderate this discussion on the impact of the pandemic on the risk for fund managers of their prime brokers as counterparties. Now, lockdowns around the world have, of course, had a direct impact on economic activity everywhere. Despite the scale of the monetary and fiscal response by governments, that shrinkage in activity is forcing companies to borrow more. It's making it harder for some businesses to service their debts, and it's making it impossible for a minority of businesses to survive at all. And at some stage, that will have an impact on the balance sheets of banks as parts of their loan portfolios turn sour. And this will happen in an industry in which the capital adequacy regime, much revised since the great financial crisis of 2007-8, is designed to increase the capital cost to banks of holding riskier assets. So the question for us in a nutshell today is, are cash-strapped and capital-constrained banks about to make it difficult for hedge fund managers? Back in March, when the markets were tanking, it was much easier to feel a crisis was looming, with markets now recovered, floating on oceans of central bank and government liquidity, and bank balance sheets are yet to feel the pain of the pandemic. So there might be a risk that managers are being complacent. Now, do central banks and securities market regulators still see hedge fund managers as amplifiers of risk? Is the coming problem not actually managers, but banks? And if it is banks, since 2007-8, all those reforms, have they made the prospects of managing our way through this smoothly better or worse? To help us answer these and other questions, we're joined by four experts in the field of hedge funds and prime brokerage. Chris Caruso is the founder of Pangea Business Solutions, which advises hedge fund managers and investors on the risks of prime brokers as counterparties. Mark Faulkner is co-founder of Credit Benchmark, the provider of consensus credit risk data. Jack Ingalls is the CEO of the Alternative Investment Management Association, which represents the alternative investment industry around the world. Last but not least, Jack Siebold is the global head of prime brokerage at Cowen in New York. Now, in addition to our panelists, we do, of course, have an audience, and everybody watching or listening is free to submit a question or a comment at any time. All you need to do is use the chat functionality at the bottom of your Zoom screen, and you can direct questions to all members of the panel or to a specific member of it, and you can do it on a fully disclosed basis or anonymously if you prefer. Now, unlike most webinars, we won't be saving any questions up to the end, but we'll be addressing them as we go along, so please don't hesitate to get involved as soon as you feel the urge, because as at all Future of Finance events, virtual as well as physical, we do want everybody to be part of the discussion. But let's begin by asking ourselves what we think is actually going on. And a pretty good starting point is what makes this situation different from 2007-2008. Back then, the problems in the repo market presaged, I think, a series of events which eventually became the great financial crisis of 2007, 8, 9. And I know that everybody on this panel will have direct personal memories of that extraordinary period. But perhaps I could begin with Jack Siebold. And as we've got two Jacks on the panel, so I must always use your surnames as well to distinguish between you. Jack Siebold, what feels the same to you about the pandemic-driven situation of today, of 2020, compared with the purely financial crisis, if you like, of 2007, 2008, 9? What are your clients asking about which is different now from what they were asking about back then?
Well, good morning, and thank you, Dominic, for including us in this event. I think it's a very timely topic, given what's transpired in the last number of months. I guess I would start by saying we've sensed it to be a very different experience. If memory serves correctly, the questions coming in from hedge fund managers, our clients, back in 08, were mostly related to how quickly they could get their accounts out of some of the banks where they had their accounts, and consider other banks, for custody. There was at that time clearly a sense of the unknown on the counterparty risk element, and a concern that that the counterparty could go away, and that there wouldn't be much left. That was the hot button, the panic at the time. I have to say, other than maybe one or two instances in late March, we've had no inquiries about counterparty risk. Now, our clearing firms happen to be in the U.S. happen to be, two very large, well-known, very well-capitalized, highly regarded banks. Neither one of which is a quote commercial bank. One's a custody bank and one's an investment bank. And I think to a certain extent, there's been a greater sense of understanding that perhaps where the pressures are, from the pandemic and the drawdown of corporate lines of credit, have much more relevance to, I believe, somebody else on the panel used the term street banks when we had discussed the topic last week. The big banks that are commercial banks and have a lot of exposure to corporate clients as well as retail clients. So I think it's very different from our perspective this time around. The concerns this time around are much more about working with the clients to get them through margin calls. It's more a plea for help as opposed to a hair on fire concern about whether the account or the counterparty was going to be there the next day or not.
The hair we have, it wouldn't be a good time for one's hair to catch fire. It would cause quite a blaze. But Jack Ingalls, you heard Jack Siebold there say that asset safety was the primary concern back in 2007, 2008. You're not hearing the same thing today. They're not worried about that their investment bank is about to fall over. They are alive to the issue of credit losses on the part of particularly street banks. What's different among your members? What are they saying that contrasts with what they thought back in, say, August 2007 to March 2008?
Yes, thank you, Dominic, and hello, everybody. And just a word on my credentials. I'm both a former prime broker, but in 2007, I was with a hedge fund management firm, very much in the heat of that crisis where we were struggling to get prime brokers to continue to support us and provide funding. And I'd agree with the other Jack that this is very, very different. That was a crisis of solvency for banks. That's not the case this time round. Back in 2008, it was very much a question of shoot first and ask questions later. And I think a lot of prime brokers damaged some very long established relationships by withdrawing support and particularly withdrawing funding at a very, very critical time for hedge fund managers. The response I'm getting certainly from our members of their experience, and particularly back in March when the crisis was at its worst in terms of declining markets and accompanying margin calls that went with that. And I think that there was, it's been reported back to me certainly that there was a lot of very constructive engagement going on with prime brokers, which was very unlike that went on in 2008, when NAV declines triggered potential action from prime brokers. I think very sensible discussions were held as to how to remedy that particular position. That was certainly not what was seen back in 2008, whereby the rug was pulled from under the feet of many, many managers. So I think the whole relationship has been a lot more constructive this time round because banks have not been not been experiencing the same level of stresses and strains that they did in 2008. So it enabled them to do that. And I think on top of that, you've got documentation, segregation of assets, everything that's been put in place with the lessons from 2008, I think have given hedge fund managers a lot more confidence at this crisis than they had back then.
Jack Ingalls. Chris, you've just heard Jack Ingalls say that one of the reasons that this relations between hedge fund managers and prime brokers haven't become as strained is because documentation is less skewed against the manager than it was back in, putting words in your mouth, Jack Ingalls, forgive me, but less skewed against the manager than it was back in 2000, 2007, 8. The rehypothecation rights are probably more restricted. The prime brokerage and swap agreements, I assume, are much better structured than they were back then, quite apart from the fact people feel more comfortable with bank risk generally. Is all that true? Is the documentation more sound than it was 12 years ago?
You know, I think it depends. I think that's true. I think the bigger issue is that in 11 years or 12 years, however you want to count it, is that hedge funds have become much more literate about how prime brokers actually work. You know, all the processes, which include documentation, rehypothecation rights, but they've been much more literate on, you know, kind of legal entity exposure, where their assets are, what their rights are. So I think that's helped them. But again, I would echo my panelists that, you know, this is a very different crisis in that for the first time in memory, you know, other than probably other than 9/11, this is not a financial sector driven crisis, right? This is a real economy driven crisis by the shutdown due to the pandemic. So the banks have gone into this you know, kind of this crisis, what I call the next war, in much better capital and liquidity position because of the regulation. And we'll talk later on the panel about, you know, some of the downsides of that regulation, but certainly the capital and liquidity position they're in right now is putting them in a good place. The other big difference from 08 is that the banks are really kind of part of the solution now, not part of the problem, right? They're playing a key intermediary role of getting liquidity and funding out to the real economy, you know, through the Fed and through other means. So it really is what I call a crisis in reverse, in that the crisis is out in the real economy and it's kind of coming to the banks, right? And how much so that will be, you know, determined. Because I really think, you know, what Jack Seabold said earlier is that it's also flipped from 08 in that in 08, the true investment banks were the more exposed banks. Now it's sort of reversed, right? Because the banks that are exposed are the banks that are the commercial banks that have real economy exposures of size, you know, not corporate clients, retail, credit cards. I mean, these are the banks that are feeling the most pressure. And you can see that through their balance sheet growth, RWA growth, things like that. So it is quite a different crisis. And I think, you know, hedge funds don't have the same immediate counterparty credit concerns that they had during 2008.
Mark, you just heard Chris at last we'd be talking about banks as though they're a monolithic thing and they're all the same thing, but of course they're not.
Yeah.
Banks are all very different. Some are investment banks, some are commercial banks, some are retail banks, some are universal banks, some are in Europe, some are in the US, some in Latin America.
Mm-hmm.
Can you shed some light on how a sensible hedge fund manager should start to distinguish between his counterparties in terms of their structure and ownership?
Absolutely, and thank you, Dominic, for the invitation to join the conversation, and thank you for my fellow panelists for sort of setting the scene to that question. What I'd like to do, if it's okay with you, Dominic, and everybody else, is just share some charts and be driven by the numbers to some extent, if that would be okay.
That would be very helpful, yeah.
Okay. Okay, can you see that?
Yes. Yes, I can see that.
Okay, that's rather good news.
Chart.
I think it's quite an interesting pink chart, therefore Source Financial Times, and full credit for them. But I think this puts it into some kind of context that we might find useful, in that for the US banks, we're jumping back to the financial crisis levels. These are the provisions, credit provisions that have just been made in the first quarter. And I would expect that they would continue to sustain and may even rise. I couldn't agree more that this is a health crisis, which has facilitated a real world economic crisis, which will challenge the financial system, but yet, as colleagues have said, is not yet a full-blown financial crisis. It's not always just about America. Bear with me just 1 second. I don't think I can screen share, just 1 second. I want to make sure that I can go, all right, there we go. The American banks are not the only ones making provisions, and the European banks are making sizable provisions here. Here, a source from Thomson Reuters puts into scale some of the larger exposures. It's a little bit worrying to say that orange, Dominic, is the UK. Red is Spain. Purple, Italy, but those colors help the reader understand. This is European exposure in billions of euros. One of the other things that's happening in the analysis that we're able to do is the rate of transition of credit is accelerating. The impact of the real world economy is impacting firms in the financial sector, in particular the banking sector, particularly Latin America. But you can see even in the systemically important banks, there are some marginal improvements offset. Certainly for the more emerging markets are potentially suffering material downward movements. And of the 310, 111 banks where we have data in North America and many in EMEA, you can see the biases to the downside. These are changes week on week, fortnightly changes. This is the speed of deterioration of credit. Here also is an important line in the credit sand, if you like. The number of organizations in the banking sector, in this particular type of sector, part of the sector, making that critical transition from investment grade to non-investment grade. And here you see the distribution within the credit world. I'm now going to look at some of the data that we have gathered, which you might find of interest. Dominic, you mentioned banks are not all created equal. I couldn't agree with you more. We have 30 GSIBs, and you can see there is a range of distribution of credit consensus worthiness of the data that we gather. The Asian banks, 8 in number out of the 30, are very well regarded from a credit worthiness perspective. Next in line, one could argue, would be the North American banks, and then the EMEA banks. It's very often the case that the hedge fund sector or asset managers don't deal with the bank whose name is above the door. We used to have a saying when I was at Goldman Sachs, who at the time were obsessed by Morgan Stanley, that there's no such thing as Morgan Stanley. Someone would say, Morgan Stanley are doing this, to which the normal response was, Singapore, London, Frankfurt, or New York. There is no such thing as Morgan Stanley. No disrespect to anybody at Morgan Stanley. But here you can see the bias towards credit quality is towards the high side for the North American banks, whilst it's more evenly distributed for those in EMEA. Of the subset of GSIBs that are prime brokers, and this is not all prime brokers, but we did the analysis in the GSIB world, you can see that once again, there are more higher quality GSIB prime brokers in North America than there are in EMEA. There aren't that many Asian prime brokers that are really playing a very significant role within the GSIB community, although one can regard the subsidiaries of some of these banks as major players, and obviously all of these players have Asian capability as well. Was that helpful, Dominic?
It is helpful, Mark. Are we able to distinguish between what I call universal bank-owned prime brokers and standalone prime broker, Goldman Sachs, Morgan Stanley versus Bank of America, Citi.
Right. I did look at that, and of the GSIBs, there really aren't only two, and you've mentioned them both, that have that investment banking pedigree, for want of a better word, and they tend to be A minus in their range. But the credit information, if I just go back to the screen share, if you don't mind, so they would be in this category here. The other thing that's worth saying is, and the credit data is quite informative actually, the AA minus sector includes an acquirer of the BBB player in the marketplace.
I think who you're referring to.
Well, I'm sure all the players around the panel and on the webinar would know who I'm talking about. So credit this is quite interesting. The other thing I would notice is a couple of players here who are in the AA minus category, probably most famous for their asset gathering, asset management role, as opposed to perhaps being banks with ATMs, are expanding their capability in this field too, through enhanced custody provision. So the story is the acquirers are here, the consolidation is starting to take place, access to credit, liquidity and capital are an important driver of these things. Expansion in this area, driven by the asset management or asset gathering processing banks, but also the power of some of the dominant incumbent investment banking players remains untarnished by this current situation. They are nothing if not adaptable. To use central counterparts specialized and help defray the cost of repo and financing to support prime brokerage clients is an important part of the mix. The development of the Pledge GMSLA, Global Master Securities Lending Agreement, is also helping them with RWA, et cetera, et cetera. But this is a big shock. There's no denying that. And I think that the jury is out whether this becomes a financial crisis because of the sheer volume of unemployment, the sheer volume of the recession, the sheer volume of corporate defaults, etc.
But if you were to give one piece of advice to managers who might be listening to this, would it be that if you have a European counterpart, particularly a universal bank-owned European counterpart, you should be more worried than if you're dealing with a standalone investment bank in New York?
To be perfectly honest, it's marginal, because within that mix, there are European banks of very strong quality as well, who are prime brokers. What I would counsel everybody to do is get well informed. And I think a lot of your discussion later will be about the kind of questions and the kinds of issues that you would want to raise. I think that access to information, removal of the emotion is very important. I think a sensible strategy to have a multiplicity of prime broker relationships, pick ones that suit you, have the capabilities that you need, and have got a strong credit standing. Look into the creditworthiness of the subsidiaries that you're actually doing business with. Don't be fixated above the name over the door. But I think that I suppose it's a fairly old cliche, but only the paranoid survive. I think you should always be worried about the counterparts you choose and always try and monitor them as best you can.
Chris, I'd like to come to you about this, because you've heard Mark say that, get informed. What sort of things should managers be looking at to get informed? How can they? You saw one of his charts showed the first quarter provisions. We haven't yet seen the second quarter provisions. So what data sources are actually available to people to get informed right now? What sort of things are your clients looking at?
Well, therein lies one of the challenges, which is that, a lot of the financial metrics are only available on a quarterly basis. So we're not going to see anything until really the middle of July, when the US banks report, and then later in July when the European banks report. So what do you do now? Which is, a question that my clients have been asking me, which is, what can we, we're talking about this back in May and in late April. And I think what you need to do is a few things. One is, generally the banks during the quarter go to somebody's conference, like I think there was a Morgan Stanley conference this quarter, and they kind of talk about, you know, how things are going for the quarter. This usually happens around midway to 2/3 of the way through the quarter, and it happened this year. And what we got out of those conferences was indications from some of the large commercial banks that, as Mark was saying, you know, the reserves are already built up pretty high for the major commercial banks, you know, and you can see, you know, if you chart that out, that it kind of, it goes down as you get to the investment banking world, and also, you know, some of the European banks, you know, the reserves are much lower. But the indications we got from these conferences, the guidance we got was that these reserves could go up again at the end of the second quarter. They could be substantial. I think the thesis of a V-shaped recovery is pretty much off the table, right? So this will be a more prolonged recovery as it comes there. So that's the one thing to watch, is the guidance that you're getting from these conferences. The other is, you know, what happened, what's similar to '08 and to now is what you should do, and what I've counseled people to do, hedge fund managers to do, is reach out to your prime brokers, reach out to your banks and say, I want to have a call with the regional treasurer. I want to have a call with your funding group. I want to have better clarity or transparency into exactly what's going on, you know, there. And these are the kind of calls we did a lot in '08, and that's what I suggested that they do. I think the other thing to watch when we do finally get to the earnings report is the key capital ratio, which is CET1. This is the ratio that's going to come under pressure because of the real economy stressing the more commercial banks, right? Balance sheets are getting bigger, RWAs are going up, and to see the impact in the second quarter, because remember, the second quarter is our first full quarter for the pandemic, right? Q1, we only had March, right? So we got a glimpse of it. Now we're going to get 3 months of it, and we're going to really see what that impact is on these banks in terms of how this pressure is going to come on CET1. And the issue you have with that is that as the commercial banks continue to support the economy and CET1 comes down closer and closer to its threshold, you're going to reach an inflection point between regulation and support of the real economy, right? And at that point, you're going to, you know, see how how the regulators react. And to date, the regulators have acted very proactively and have helped the industry, you know, through a number of moves they have made. However, you know, this is another point that is coming that needs to be watched. And then the last thing I would say is, you know, echoing some of what my colleagues have said, is that you should always be thinking about, you know, again, if the crisis keeps backing up out of the real economy into the financial sector, right? You still want to be looking at your prime broker exposures. Most of the large hedge funds have multiple prime brokerage relationships, right? You always want to be watching, you know, how you're balancing your NAV exposure across these counterparties. So those are the things I think they should be thinking about.
Just very quickly before you go, are you getting any anecdotal evidence from your clients about whether this situation is deteriorating? By which I mean, what's happened to leverage since March, for example? So
well, of course, we had a huge deleveraging in March, right? Which, you know, like that has kind of a double-edged impact on prime brokers to begin with, right? Because not only does the deleveraging affect their profitability, right? It also affects their ability to be efficient with their balance sheet, right? Because as the leverage dries up, there's less ability to use assets to offset, you know, longs and shorts and be more efficient and use less real balance sheet. So that's what they had there. Anecdotally, what I'm hearing is the leverage is coming back, but it's coming back slowly. It's not coming back. You're not getting a V-shaped recovery in leverage. So again, this is, you know, potentially putting pressure on, you know, the balance sheet not being as efficient as it was. That combined with the fact that there could be balance sheet pressures in other parts of the bank, right, as they're trying to support the real economy. You know, thinking back, I mean, Jack Inglis, Seabold is a prime broker. Jack Inglis was a prime broker. Everybody knows, and Mark was at Goldman. You know, everybody knows that balance sheet is finite, right? And we know that every quarter it's a balance sheet management exercise, and that's no different now. and there are pressures on balance sheet now that did not exist prior to this this health crisis.
Jack Ingalls, you wanted to comment on that?
Yeah, if I can just add some other questions that the hedge fund managers should be thinking about right now. I mean, of course, the creditworthiness of your counterparty is an important question you want to ask and something to get to the bottom of. But that's really important if the counterparty is going to default. But there's a lot more things before you even get there that I think are very important to ask. Prime brokerage is just one business unit within a bank, whether it be an investment bank or whether it be a universal bank. So it competes for balance sheet, risk-weighted assets in the same way that every other department and business unit will do too. So I think one of the real questions to ask of your prime broker counterparty, or certainly something to try and investigate, is how profitable is the business still? Because if the business is declining in profitability, then the risk goes up and it becomes higher, that less resources will be allocated to that business. And I think you do need to understand that. I think at the individual level too, as a manager, you need to understand where you rank with a prime broker, what the value of your business is to them, not just in prime brokerage terms, but actually in full bank terms. And the answers to those questions will give you some insights as to how you might be treated as a manager and for your funds if the situation deteriorates from here.
Yeah, I might just add. I think it's very important to distinguish between the really, really large hedge funds for whom this is a real issue, and the emerging manager class, who represent a reasonably large a pool of assets, who while I agree with Chris, the hedge funds or the people they have working for them in risk ought to be talking to their prime brokers, ought to be talking to their the regional treasurers, et cetera. The reality is that the emerging manager doesn't have a shot in hell at getting the attention of anyone like that at any of the large prime brokers. And so I think, perhaps maybe a little bit more down to earth, what can managers do? Well, one, I think, is just, be cognizant of where there has been a consistent pattern of commitment to prime brokerage and where there has been a consistent pattern of divestment or walking away from prime brokerage. And before the crisis hit, right? So if you look at the last 10 years since the big financial crisis, what's transpired? Well, 3 of the former top 5 prime brokers in the world don't rank there anymore. One of them walked away from that business completely and handed it off, at least partially, to someone else. And there's been a complete reordering of the rankings. And this is not a US versus Europe thing, but the reality is there really a large European bank that legitimately ranks in the top 5 in prime brokers at this point? Certainly not in the top 3. And I think, if your prime broker is a European bank that has shown over the past 3, 4, 5, 6 years a continuous pattern of downsizing its balance sheet, reallocating assets elsewhere, walking away from other elements of the investment banking business, like equity trading, sales and trading, then those should be important tells to you as well as to potential counterparty risk down the road, whether they'll be there or not. And so, for managers who are, not of the size and can't command the kind of attention from their prime brokers that perhaps, the bulge bracket, firms can, I think that's been an important, element or an important place where managers can at least, outwardly see whether banks are committed to a sector, to this sector or not.
I think these are all great points, and I would take Jack Inglis's point that creditworthiness is just one of the many things that you take into the mix as being absolutely correct. I think one of the things when you try and hire someone, you want someone who's capable and willing. They can be capable, but just lazy, and they'll be rubbish to hire. Or they can be willing, but incapable, and it's a waste of everybody's time too. What you want is a prime broker that's owned by a bank that is capable and willing, capable to allocate the resources to support the business, capable to allocate the balance sheet capital, etc., that you require, the technical resources that you require, and build the infrastructure around the multifaceted product that is prime brokerage to meet your requirements, whatever type of asset manager you are. So look for capability and willingness. Chris mentioned the importance of up-to-date information, and I cannot stress how important we believe this to be. Might I share again a couple of things that might be helpful? Share. So here is, and I think the other thing, to Chris's point, don't confuse frequency of updates in credit information or information with accuracy. Credit default swaps, we are told by lots of very sophisticated risk managers, are an excellent source of information. I don't disagree with that. But you should not be sort of persuaded that just because they move a lot means they're accurate. They're trading instruments, they're hedging instruments, and they also don't cover the full sector or segments and the companies that you might want to trade. On the other hand, at the different side of the sector, you have the issuer pays credit rating agency models. They are designed by their providers for their customers to be stable. They are not meant to be moving. So one would argue their accuracy is something that you might want to question too. We mentioned earlier on the differences in different kinds of providers, and here we did an analysis of broker-dealers, and you can see it's actually a reasonably fair fight with a slight sort of benefit by being owned by a broker-dealer. Doing the analysis yourself and gathering information is a significant challenge and task, and many hedge fund managers are not properly resourced to cover the waterfront of entities that might matter to them. Nearly all of them will be directly or indirectly through a sponsored capability accessing counterpart clearing, the CCPs, and they will be part of a chain of CCP members that are important in the sort of structural strength of those organizations. Monitoring just central counterparts is a full-time task for many teams at banks, and probably not within the capability of the typical hedge fund manager. And to your point, Jack Siebold, not the kind of thing that the emerging fund managers would be able to commit resources to. So you do need to find this information where you can. Broker-dealers have had a difficult time. Remember, these are transitions over a 2-week period. And also the custodians and sub-custodians which carry the assets and hold the assets are important to understand too. So the point I would make is look for a counterpart that's capable, that's willing, that is able to provide the support that you need as a business for the kind of transactions that you want to do, and perhaps consider a variety of different information sources outside of your own capability to feed into your early warning analysis. I cannot agree more with something that Chris said earlier. Make sure you ask the questions of your providers that you need to know the answers to. That is absolutely critical in every activity that one does.
A question here, and we've been necessarily a bit coy, I suppose, about individual firms. We've drawn a distinction between Europeans and North Americans and Asians. We've drawn a distinction between standalone and universal bank-owned providers. And Jack Siebold made some observations about check the commitment over time of some of the institutions which are your counterparties. But the question here is very straightforward. It's, what are your clients saying about prime brokers? And I guess that question is asking, is a much more vectoral one. They're saying, this is a manager asking, who should I be worried about? And if you were to answer that question, what would you actually say? Could you be more specific with that, Chris?
Well, it's something my clients ask all the time through the various things that I do for them, which is there anything I should be worried about, right? And as everyone has said, I mean, this is not a '08, and there's not an imminent deterioration of balance sheet and liquidity and capital and things like that. But, you know, a couple of things that were said, I mean, which is both Jack Inglis and Jack Siebold talked to this point, which is it also matters who you are, right? In terms of access to information, in terms of how you're going to get treated. And certainly, if, as Mark Faulkner was just saying, you know, the resources you have to actually keep track of your counterparties. Only the largest hedge funds have the ability, have the teams that are large enough in their treasury or COO group that can even attempt this. And as you get, you know, down the kind of the hedge fund food chain, and Jack Inglis knows this probably better than anybody, is that, you know, their concerns are different, their capabilities are different, right? You know, and in terms of, you know, Jack Siebold's point, which is, you know, if you're a $300 million hedge fund manager that's been in business for 2 years and you call up to ask to talk to the regional treasurer, it's a different thing, a different response than if you're a $20 billion hedge fund who's been around for 15 years that's paying them a lot of money. So it does matter who you are in that regard. But in terms of, you know, if we go back to what's really going on here, I think there's been a shift over since the crisis to the large universal banks that have prime brokers. You know, let's say, call it the U.S. bank story. You can only go so long before we name names here, right? And that's been a trend over the last few years away from the European banks, right? As, you know, banks have, you know, resized their prime brokerage businesses, not exited, but, you know, certainly the collapse of the equity division at Deutsche Bank has, you know, kind of shifted the landscape as well. And this is a real opportunity, though, if you think about it. And I think when I talk to the banks, they are recognizing it, which for the, you know, the investment banking type prime brokers, the ones that are really, you know, stressing wealth management over the last few years, they still have prime brokerage businesses that they view as wanting to be competitive, you know, despite the, you know, kind of the street perception of them. And this is a real opportunity potentially to, again, it won't be as severe probably as '08 when, you know, things really leveled off in terms of playing field between the big three and everybody else. And then it kind of went back that way. But this presents a real opportunity, I think, for that. But, you know, as Mark Faulkner said, just to talk about, you know, what should we be worried about? I don't think that we have anything from a credit quality perspective to really be worried about imminently, but it certainly could, as Mark's slides show, you know, you get a bad quarter for Q2 and it goes into Q3, then it's, you know, then it starts to be, you know, something different.
So Jack Inglis, could I ask you, if let's say Chris's worst scenario turns out to be true, and the banks, universal banks, money center banks, whatever you want to call them, have a terrible second quarter and it starts to look bad in Q3 as well, and so there is a balance sheet impact. You as a hedge fund manager, as you yourself pointed out, are competing for that balance sheet with lots of other businesses. Is there something peculiar about the prime brokerage business in the sense that what used to make it attractive was you've got to use all the client's cash and securities? Is there something about it which makes it more exposed on the downside when you are competing with other businesses for a share of a bank's balance sheet? Does it become, as I think Chris implied, you know, hedge fund business becomes less and less attractive vis-a-vis other things you could be doing? Is that a reasonable view, or am I wrong about that?
Look, I think all the evidence that I've seen still points to prime brokerage being a very profitable business on a number of different very important metrics, whether that be return on balance sheet, return on equity, return on risk-weighted assets. I don't have the up-to-date information as to what it's looked like in the first half of 2020, but so what I'm really going back to is consistent data coming out of Coalition that proves that it's a profitable business, and I think that that answers the question as why other players are still trying to get in at times that others may be pulling back from that business. You know, I think what I worry about more, and the questions I would want to ask banks about, is less about their current credit worthiness, but actually to what extent they are and have been constrained by the regulations, particularly during the past few months. And where my focus tends to be at the moment is less in what you might have considered the traditional prime brokerage world of funding long-short equity positions, but the dislocation that we saw in government bond markets, and particularly in the US Treasury market in March, where the unwind of positions did create some quite substantial dislocations in Treasury market vis-a-vis futures, vis-a-vis interest rate swaps. And so there were some pressures there, and far more than, say, in conventional cash prime brokerage in equities, where the deleveraging, as far as I was always told, was actually done in a fairly disorderly way. Now, why is that? The US Treasury market is the most liquid market in the world. It should be able to deal with what was maybe a 50 to 100% increase in volume over a period of days. In terms of increase in volume, was actually less than that of the increase in volume that we saw in the equity markets at the time. So how come the largest market, securities market in the world, began to seize up and needed central bank intervention? Well, I think that's down to the strict new, particularly liquidity ratios and liquidity coverage ratios that have been put in place since the financial crisis. And so banks were unable to act as an intermediary, as a warehouser of risk, and as a provider of funding in the biggest market in the world. And I don't think that was a bank's choice. It's what they were restricted to do, and that potentially had some systemic risk. And I think the question that authorities need to go and look at here is that, have they gone too far in handcuffing the banks to act as an orderly intermediary at times of stress in the marketplace? And I think that's one of the things that needs to be looked at. But my major concern is that hedge funds are being described, and the Bank of England was the most recent to say so, that hedge funds were the biggest amplifier of stress in the Treasury market in March. And that really can't be the case. And I think a much deeper look at the interconnectedness of markets, intermediaries, participants, and hedge funds needs to be carried out.
I know you want to come in on this, but I'd just like to bring in Jack Seabold, particularly on Jack Ingles's point about what happened in the US Treasury market. What's your perspective on that? The way you were sitting in the middle of it.
Yeah, I mean, we really didn't see much of that. We're not very big in the Treasury market in our book of business. Where we did see it as a real problem was in emerging market govies. That's where, I mean, pricing was all over the place. The banks that we were using to fund our clients' positions were significantly reducing the margin they were willing to extend on sovereigns. They're emerging market sovereigns, but they're sovereigns, and so they went from trading, at let's say a 15% requirement to trading at a 35 to 40% requirement overnight. And that created a real problem for, what turned out to be, give or take, about a week or 10 days worth of trading days. And it was really awkward, again, because, though it wasn't treasuries, they were sovereigns. And the presumption was that, perhaps they aren't the most liquid. They certainly, from a counterparty risk perspective, have the governments of these countries, supporting them. Some of them weren't even very far out on the risk spectrum, if you will, on emerging markets.
Thanks, Jackson. Now, Chris, I'm going to come to you in just a second. Mark, while Chris is talking, I'd like you to think about a question we've had, which is the reason that we should be more concerned about European banks as prime brokerage counterparties due to the fact that European banks have done a lot less to clean up their balance sheets since 2008-9 than American banks. I think you probably need a bit of time to think about that. So
Well, no, I've got some data on that, and I think it's a fascinating one. I'll hold.
okay. So Chris, you wanted to.
Yeah, I just wanted to follow up on Jack Inglis's point about regulation. I think that is a real issue. I mean, my question is, will the regulators use this crisis as an opportunity to clean up some regulations that create unintended consequences? And the one that Jack Inglis talked about is a perfect example. It also happened last September in the U.S. repo market. It happened the previous December during the market break in 2018. And, and the Fed has, they've tried to do a couple of things right away, which have helped, right? They put a temporary change to the supplementary leverage ratio to take out reserves held at the central banks, take out treasuries, to provide some relief there, which that type of relief goes directly to prime brokerage, because SLR has been a binding constraint on prime brokerage, right? Where there's not as much of an RWA situation. But some problems still remain. I mean, Jack Inglis's point about, this intraday LCR is an issue. The other issue that is particular to the US is the GSIB surcharge, right? Which is set once a year on December 31st. And what happens every fourth quarter, is the banks aggressively manage to the threshold that they want to be at, right? So what happens is the bank balance sheets contract significantly in the fourth quarter of every year, right? Now, again, if this crisis plays out the way we think it's going to be, which is a slower recovery, we could have a collision in the fourth quarter of 2020, where the banks are going to be in a real dilemma of continuing to support the economy at the same time that they're trying to get this component of CET1, the GSIB surcharge, down to a level that they want to be at. And you can look at any analyst call over the past couple of years, and they talk about this. And if you're a prime brokerage client over the past couple of years, in December or in the fourth quarter, you're getting a call from these banks saying, can you put this in swap? How about an over the year-end trade? Things like that. This is not the year, right, for that to happen. This is the year they should rethink how that surcharge is calculated. Last point, throw on top of that this is the first stress test, CCAR, that is going to now introduce the stressed capital buffer, which is another component of CET1 that is replacing a fixed capital buffer. So this is a real opportunity that I hope that there's active dialogue between the banks and the regulators, particularly the Fed, to kind of squeeze some of these type of bad incentives out of regulation, and use the crisis as an opportunity to do that.
I ask an impertinent question, which is if banks are managing their balance sheets to make a capital surcharge number in Q4, what's morally different about that from the way that Lehman Brothers is managing its balance sheet in 2007?
Well, it's government driven, right? I mean,
we have a question here. It has the regulation of 2008-9 made the situation better or worse, or a bit of both?
I think it's both.
What do you think, Jack Inglis? Do you think the regulations made things better or worse, or a bit of both?
If you think about what the intention of those regulations, I think it's made the overall financial system better. But as Chris says, there are some unintended consequences. Like all regulation has unintended consequences, and you always need to come back and look at what those are and have a discussion and have a consultation as to where things can be improved. And I think now is a perfect opportunity for monetary authorities to do so, and I hope they will.
Be flexible in their application in difficult times, I guess, as well. Now, Mark, let's come back to my question about European versus US banks.
It's as always complex. We've been doing quite a lot of work with banks to address what one can call the impairment issues to do with International Financial Standard Regulation 9, which affects their real world accounts, or CECL in America. And I can tell you that the banks of the world prior to the crisis were confused, and now they're even more confused than they were, particularly those that enjoy the regulation of a global suite of regulators. I would argue that in answer to the question, have the regulations been helpful? I think it's mixed. Unintended consequences are a fact of life, but I think they have been better implemented in America, North America, than they have been elsewhere. And as a result, the banks of North America are stronger relative to their global peers, and particularly those in Europe. 27 countries trying to fudge a solution is always going to be more of a challenge than, notwithstanding the multiplicity of states in America, but the federal resolve to do this. That has meant that, as I think Chris mentioned earlier on, in this real world crisis, the banks are in a different position than they were in 2008. They are the lifeboats. They are expected to help and provide support for the real world economy. They're the conduit through which many of the things that will unfold over increasing months will be delivered to help save that economy. Now, on one shoulder, or if they have an American regulator, as evidenced by the scale of some of the impairments, they're saying, throw the kitchen sink at it in Q1. Really just take the worst case scenario, take the numbers on the chin. The European regulators are saying, no, you're meant to be the lifeboats. Don't slash the lifeboats, because the computers will say no when you're asked to be saved, and it will be a long U-V-shaped, U rather than a V-shaped recovery. Don't throw the kitchen sink at it. So we're seeing this challenge and it's driven by the capability of the banks post the response to the previous crisis. So it is choppy, it is confusing. And I think that, to the point that someone just made about the inclusion in CCAR of stress capital for the first time, I think quite a lot of people thought that some of the stress economic scenario generating solutions under the stress tests that were globally being implemented were somewhat ridiculous. Not so much now. Now
this regulation isn't over yet. There's another
not at all.
Piece of Basel III still to be implemented. I think the year after next, something like that.
Yes, 22, 23. It's just been slightly delayed. Basel IV is potentially very important for the prime brokerage community, because it will mean that banks will not necessarily be able to rely upon their own calculations of creditworthiness to drive RWA and capital calculations as they currently do. And there will be a 100% capital charge for counterparts on the buy side that have no rating in the real world. And what that will mean is 100% capital charge unless they can find a rating. And it is possible to mitigate this with pledge agreements, with specialized central counterparts in repo and securities finance, and potentially using ratings coming from external sources. But this is going to be a major challenge for the industry, not only for the banks, but for their underlying customers who need to face this. I think if I was a prime broker customer, one of the questions I'd want to ask is, to what extent is your securities financing, prime brokerage, repo, securities lending, everything, self-funding? Because there are some that are pretty close to self-funding. And there are others that, for whatever reasons, aren't wired up as well, perhaps, aren't feeling the pressure so much, which has been growing for years, and are reliant upon the mothership for capital. I think that's a critical question to understand. Are you profitable? To what extent is your financing Delta One prime brokerage business a capital beneficiary of the regress of your parent? And some of them will be able to say, and it may well be the investment banking driven banks, not so much as you might think. We rehypothecate assets, we trade in the swap market, we actually use these assets and generate financing as efficiently as we can through our sophisticated bank resource management techniques, and the fact that we've been who we are for such a long time. We've never relied on the parent as much as you might think. So I'm not saying all prime brokers are like that, but that's a great question to ask.
I might just interject.
But Jack, come in on this. Yeah.
It's just sort of I know we're talking about, the reserves taken by, all the banks in the first quarter. We're sitting here with, bated breath on what they're going to do in the second quarter. At least from where we sit, and seeing the banks that have a very large presence in investment banking and the capital markets, kind of like the disconnect between the real economy and the market, the stock market. I think there's a disconnect between what's going on in the commercial side of the bank and the investment bank. New issuance has been off the charts in recent weeks, the last probably like 8 weeks. Trading volumes are at an elevated level. So those that have exposure to the capital markets are probably counterbalancing, at least to some extent, the reserves they're having to take on the commercial side of the house, with revenues they're generating on the capital market side of the house. So when we get to mid-July, late July, and all the banks are starting to report, we may see some more of this spread between those that have the capital market exposure versus not.
Managers need to get out before the central banks do, from the sound of the market you're describing. Anyway, we're very short of time, but I'd like to leave the listeners with some concrete ideas as to what a lot of managers listening, some concrete ideas as to what they should actually do about this, apart from get out before the central banks do, which I'm sure they don't need to tell them. Do they, for example, Jack Siebold, maybe Jack Ingles has a view on this, or do they need to get ratings? What else should they do? And after all, there have been probably plenty of problems they're facing, which predate the pandemic, which won't have gone away and may even have been made worse by this situation. What would your advice be to managers about how to manage the risks we've talked about today? Do they need to put a formal process in place? Do they need to get a rating, as I say? What sort of steps do you think they should be taking?
Well, I think at the very least, to the extent they have concentration of assets with certain prime brokers, they should be exploring the options with additional prime brokers, and spreading out the risk across a wider range of counterparties. The risk managers always run is sort of dealing, trying to balance, if I don't have as much with, counterparty A, I'm not going to be as relevant to them, and they may not give me the same kind of treatment, as I've had for some period of time. So it's a balancing act. But the reality is, I think that managers owe it to themselves and certainly to their investors, to explore, spreading the counterparty risk across a broader audience of banks.
Jack Ingles, you said one of the pieces of advice you gave a few minutes ago was to work out what your business is worth. You just said Jack Siebold say, be relevant to your prime broker, but not so relevant that you put your entire business at risk. It is a balancing act, isn't it? What would your advice be to managers looking to take away from our discussion this afternoon, some concrete things they should do? We've lost Jack Ingles somehow. He's disappeared from my screen. I don't know if you can see him. Maybe Chris, you could pick up this thread. What are you advising your clients to do about managing the risk that we've talked about?
Well, like I said before, I think, and we've all talked to it, and Mark brought up a great point there, is like when you're having the conversation, first of all, as Mark Siebold said, if you have the standing to have these conversations, then I think, these are good questions to ask in terms of just, where are you in terms of where they've been in the past couple of years, is that prime brokerage has taken an ever increasingly important position in the profitability of these banks, whether it's a traditional investment bank like Goldman Sachs or a large, universal bank like JP Morgan. Prime brokerage is real. If you look at the analyst calls, they talk about prime brokerage all the time now. When I was in prime brokerage, they never talked about it at all. These are really important businesses. And I think the point that was made earlier that are these still important businesses? And I don't think somebody's going to get on the phone with you and tell you they're not, but you still need to have these conversations. And I think because the other part of the continuum of risk, not just counterparty risk, is relationships, right? And this is an opportunity to get closer to your banks so that you have the relationships, not just to know what's going on, but so that you know the people that can help you in these banks, right? This is the time to really look to build relationships and stay closer to these to your counterparties, and that can only benefit you in the long run.
Is there a process which managers should put in place? Should they be looking at a range of data points once a day, or once a week, or once a month?
I think that the biggest issue that all hedge funds face is that the largest hedge fund is still a pretty small company, right? So their biggest issue is capacity, right? Do they have the capacity to actually spend time on this issue, which is monitoring their counterparties in a meaningful way? And I'm sure Mark Faulkner, this is, kind of the root of his business as well. This is very complicated stuff, right? It's complicated stuff. And even the largest hedge funds don't have the capacity to do it. But I think, the alternative between having no process and a process like a $30 billion hedge fund is not the way to look at it. You can right size a process for monitoring your counterparties, right? Depending on the size of your bank, but you should do something, right? If it's monthly, quarterly, an annual due diligence or something, an annual meeting with your prime brokers, you need to do something in this field, right? You just can't say I'm too small to do it, right? You can't tell an investor I don't do a counterparty risk evaluation of any kind. So they need to do something. And depending on your size and your capabilities, it could be more frequent or less frequent, but they should be doing something.
Mark, final word from you.
Right. I've made a really scribbled list. Read your documentation. Make sure you're as literate as you need to be with all the documentation that reflects the state of the art. Understand the profitability of your providers. Understand the dependency that they have of the name above the door. There is no such thing as Morgan Stanley, as I've joked before, but you get the drift. Are they capital drains upon the business or are they not? Maintain and decide to have, notwithstanding the issue of spreading your profitability, to have a diversity of providers. The state of the art, as Chris alluded to, is an understanding of many aspects of the supply chain that you have. Prime brokers supply many, many things: leverage, clearance, reporting, cap intro, execution, or access to deals, etc. Many things. So they are suppliers of many things, just as a property company is a supplier of many things. The state of the art is actually understanding and measuring in some capacity, as best you can, as Chris says, right sizing for your organization, what that risk profile looks like of your supply chain. You are nothing if you're a hedge fund manager if you can't clear your transactions, if you can't provide your investors with the returns that you generate. You have decided not to sit inside of a large organization with all of that stuff available. You're outsourcing yourself as a fund manager and you're depending on others. You're duty bound to find the best providers, understand their strengths and weaknesses, be able to communicate that to your principals and your investors. And it is a very challenging task because the interdependency and connectedness of the capital markets is so significant a chain. You think you're dealing with a CCP, but you're dependent upon the strength of the chain of the members. You think you've chosen a custodian, but they outsource sub-custody to 80 other firms around the organization, around the world. These are complex matters. It is not beyond the wit of people who stand ready to manage assets with individual strategies and do things to address these issues. And I think, like all of the panel, would urge them to not ignore it just because it's difficult, to run towards the fire before it gets out of control. The good news is, I don't think the business is on fire. The industry of prime brokerage is on fire yet.
The point I'm taking away from that is that when you plug into a prime broker, you're not just plugging into a prime broker who might lend you some money and clear your trades. You're actually plugging into a network of networks, sub-custodians, central counterparty clearing houses, CSDs, the whole universe out there. These risks are very, very difficult and complex to manage. But look, we're 10 minutes over, so I think we better stop. I'd like to thank you, Chris. I'd like to thank you, Jack Siebold. I'd thank Jack Inglesby, who managed to stay online, but somehow we managed to lose him. And thank you, Mark. And thank you for taking part in this discussion. We will be writing this up and circulating it within a few days, I hope. So look out for that when we send it out. And please say thanks to all our panelists as best you can on this Zoom technology.
Thank you, Dominic.
I think. Bye-bye.
Thank you, Dominic, for hosting.
Thank you very much.
Thank you, Dominic, and thank you to our panel. If you would like to see the summary of this discussion, please visit our website on www.futureoffinance.biz. And indeed, if you would like to see the video again, that is also on our website. Many thanks.